Just a quick one from me this morning. So Tangy and I right now are in the middle of preparing all of our end-of-year equity strategy products for your clients to read through the summer holiday period. Part of that process has been taking a bit of a health check across the market as we exit AGM season, just to try and set the scene on where we are in markets coming into the February reporting season, which is going to be crucial. So just wanted to present a few slides that we dug out in terms of looking at momentum in earnings expectations in particular on the Australian market. And as we all know, the Aussie market's held up incredibly well relative to more difficult jurisdictions overseas. But just wanted to point out a few trends that we are noticing. So just to set the scene, the year-on-year forecast profit growth for industrials-only companies on the ASX as we came out of reporting season in September was a very robust, very healthy 8.8%. Now that EPS momentum or profit growth forecast at the aggregate level since then has actually improved since September. So we're now looking at FY23 profit growth of in the low 9% range. And that's actually in line with the very long-term average in terms of corporate profit growth in Australia. What I did want to call out, though, is that there are some sort of slightly, not concerning, but noteworthy trends to that data. And really the first one is that how incredibly concentrated that positive performance has been in some very small sectors and stocks. So the overwhelming driver of that improvement since reporting season has been upgrades across the major banks. And you can see on the right-hand side there, if you split out every sector and look at price performance versus EPS revisions versus, the resultant PE revisions, what we've seen is a very broad price improvement across every sector on a weighted basis, but very few of those price improvements have been driven by EPS upgrades. And the notable sectors that have enjoyed upgrades have been the major banks, the insurers, a couple of the packaging stocks, Qantas, massive upgrade. And then we struggle to see many, material upgrades across the rest of those segments. So really it's been PE improvement that's driven most of the price rating across the non-bank sectors in particular. Now this trend, I guess the other trend to call out is that blue line on the left-hand chart there showing you that most of that improvement in expectations did occur in the months just straight after reporting season. And as we actually exited AGM season, the earnings trajectory has deteriorated somewhat. And we can see that in this slide here. If we look at across the entire market, or this is just industrials only, so we normalise out the impact of commodity price movements for the sake of simplicity here. What we do show you here is that, that 8 to 9% profit growth expectation across the industrials universe is sound and it's held up quite well. But as you can see there, it's been the big banks doing all the heavy lifting, making up for generally, I wouldn't say it's across the board, but there has been notable pockets of downgrades in some larger stocks that I've called out in red there. So I'm not, calling anything dramatic just yet, but I do think there is scope for downgrades to keep accumulating as we head into that start of February, all-important reporting season. If you look at the late AGM period, 9 of the 24 trading and AGM updates we did see through November crystallise downgrades in EPS expectations of sort of 5 to 10 or plus 10%. Now, I know that a lot of those stocks we don't cover or we've carefully avoided. Names like James Hardie, Pendle Group, Virgin Money, Select Harvest. We don't even cover some of these stocks, but I'm just curious and wondering that some of that momentum, that weaker momentum, might translate across some of our covered stocks heading into reporting season. And as we all know, as there's less and fewer money managers at their desks through the holiday period, lower liquidity, that might throw up some interesting opportunities in some names that may get oversold. So that's just a quick health check in terms of market momentum. Just a few products that have and will be hitting your inboxes shortly. Last Thursday or Friday, I believe it was, Tangy updated the best ideas for December. Couple of changes, Pro Medicus coming out, Technology One in the tech space, done incredibly well. Nick's replaced that with Xero as his preferred tech stock. 34 very good names there across every sector. I won't go into the detail, but do have a look at best ideas. And then just flagging as to what's coming up in the next couple of weeks as your clients do start to go on holidays. Quite a few products to hit their screens. So this week we're updating the equity sector strategy outlook pieces. That's the market-wide per sector, per analyst, top-down view on every sector ratings, couple of key picks, and outlook into 2023. Today we're meeting with the investment committee for the last time, looking at the equity model portfolio positioning as we head into the summer period. We've got the global leaders update coming out next week, along with the asset allocation update for 2023. That's a very chunky piece, as you know. And then that leads into Investment Watch for publishing, I think, next week as your clients do start going on to leave. Just wanted to also flag that work has begun on the reporting season preview materials for publishing in late January. There's going to be a host of very important quarterly updates coming through January. As I said, probably some more trading updates to hit our screens. So we're looking at a lot of preview material around reporting season very shortly after Australia Day, as you're all coming back to work into a very busy reporting season in February. So do have a look out for all of these products coming your way very shortly.